This is Veriscope News. Verified news, clear context. Each report explains what is happening, why it matters, and how to understand the data clearly. We rely on primary reporting. We avoid opinion. We avoid speculation. Our focus is accuracy and proportion. We explain numbers in plain language. We provide long-term context. Today's report examines the latest U.S. labor market data, specifically new filings for unemployment benefits. These figures are released weekly. They are closely watched. They often move markets. This report is based on confirmed data from the U.S. Department of Labor. It also includes analysis from the Federal Reserve's regional survey. The goal is clarity, not urgency, not prediction. What follows is a factual explanation of the latest jobless claims report, the numbers, the background, and what analysts are monitoring next. Weekly jobless claims are one of the most timely signals in the U.S. economy. They measure how many people apply for unemployment benefits for the first time. The data is released every Thursday. Because of this frequency, the numbers can be volatile. They often move due to calendar effects, holidays, weather, temporary shutdowns. For this reason, economists rarely treat a single week as a turning point. They look for trends across months. They compare the data to long-term averages. The current labor market is not expanding quickly. It is also not contracting sharply. Most indicators suggest a period of balance. Hiring has slowed. Layoffs remain limited. Job creation continues, but at a modest pace. At the same time, businesses are adjusting to structural changes. Technology investment is increasing. Workforce planning is becoming more cautious. This environment makes short-term data harder to interpret, especially around the end of the year. Seasonal adjustment models attempt to correct for these patterns. They do not always do so smoothly. The latest claims report falls within this context, a single data point inside a stable but restrained labor market. The latest report covers the week ending January 10th. Initial claims for state unemployment benefits fell by 9,000. The seasonally adjusted total came in at 198,000. Economists surveyed before the release expected a higher number. The forecast average was 215,000 claims. This difference was unexpected, but it was not viewed as a major signal. The U.S. Department of Labor released the figures on Thursday morning. The data applies nationwide. The decline suggests fewer people filed for benefits during that week. However, analysts caution against reading too much into the change. Seasonal factors are significant in early January. The end of the holiday hiring period affects the data. Retail staffing patterns shift. Temporary contracts expire. Seasonal adjustment models attempt to smooth these changes. They rely on historical averages. When behavior shifts, the models struggle to keep pace. The Labor Department does not revise the models weekly. As a result, short-term distortions can appear. In addition to initial claims, the report includes continuing claims. This measures how many people remain on benefits after the first week. Continuing claims declined by 19,000. The seasonally adjusted level was 1,884,000. This figure is often used as a proxy for hiring. When continuing claims fall, it can suggest people are finding jobs, but the signal is imperfect. Overall, the report shows fewer new filings, but it does not show strong hiring momentum. To understand the significance, it helps to look at longer trends. Over the past 10 years, initial jobless claims have averaged roughly 240,000 claims per week. The current level remains well below that average. During economic expansions, claims often fall below 200,000. During recessions, they rise sharply. In 2020, weekly claims exceeded 6 million at the peak. The current environment is far removed from that period. The labor market has normalized. However, job growth has slowed. In December, non-farm payrolls increased by 50,000 jobs. That figure was below the long-term monthly average. For all of 2025, the economy added 584,000 jobs. This was the smallest annual gain in 5 years. The average monthly increase was about 49,000 jobs. The unemployment rate fell slightly. It moved from 4.5% in November to 4.4% in December. Despite this decline, Long-term unemployment remains elevated. Some workers remain without jobs for extended periods. Federal Reserve data supports this view. The Beige Book is a summary of economic conditions across 12 districts. The latest edition reported employment was mostly unchanged. Several districts noted increased use of temporary workers. Employers cited flexibility as the reason. Hiring was often limited to replacing workers who left. New positions were less common. Structural factors also play a role. Businesses are investing heavily in automation and artificial intelligence. These investments can improve productivity. They can also reduce the need for additional staff. At the same time, trade and immigration policies affect labor supply and demand. Economists note these forces can slow hiring without triggering layoffs.
The labor market affects households in several ways. When layoffs are low, income stability improves. Most workers remain employed. This supports consumer spending. However, slow hiring limits opportunities. Workers seeking better positions may face fewer openings. Wage growth can moderate. Prices are influenced indirectly. A stable labor market reduces pressure on wages. Lower wage pressure can help limit inflation. This is one reason central banks monitor employment closely. For jobs and labor conditions, the current pattern suggests balance. Companies are not aggressively cutting staff. They are also not expanding rapidly. Temporary workers play a larger role. This allows firms to adjust quickly. It reduces long-term commitments. For savings and investment, steady employment supports household balance sheets. People are more likely to maintain savings when income is predictable. However, limited job mobility can slow income growth. Businesses face a different set of trade-offs. Hiring is costly. Training takes time. When demand is uncertain, firms prefer flexibility. Technology investments substitute for labor in some tasks. This can raise productivity without increasing headcount. Small businesses are particularly cautious. They often lack the margins to absorb hiring mistakes. Temporary staffing becomes a risk management tool. Large firms take a similar approach at scale. They rely on contractors. They delay permanent hiring decisions. The broader economy reflects these choices. Growth continues, but at a slower pace. The decline in jobless claims does not change this picture. It fits within a stable range. It does not indicate acceleration. For households, this means fewer disruptions, but also fewer breakthroughs. For prices, it supports gradual disinflation. For employment, it signals a holding pattern. Analysts are focused on several upcoming indicators. The monthly employment report remains central. Payroll growth, labor force participation, wage changes. Weekly jobless claims will continue to be monitored, but emphasis will be placed on multi-week averages. The Federal Reserve's Beige Book will provide additional insight. It captures qualitative feedback from businesses. Job openings data will also be reviewed. This shows how many positions employers are actively trying to fill. Continuing claims trends matter as well. They offer clues about hiring effectiveness. Economists will also watch productivity data. Technology adoption influences labor demand. None of these indicators alone define the outlook. Together, they help describe momentum. For now, experts describe the labor market as stable, not overheated, not weak. That assessment remains unchanged. The latest report shows fewer new unemployment filings. This is a positive data point, but it is not a turning point. The broader labor market remains steady. Most people who have jobs are keeping them. At the same time, hiring is selective. Opportunities exist, but growth is measured. Understanding this context helps avoid overreaction. Weekly numbers fluctuate. Trends matter more than single releases. The current data suggests continuity, not acceleration, not contraction. Stability remains the dominant theme. Seasonal adjustment is a statistical process. It removes predictable calendar effects from data. Holidays, weather, school schedules. These factors repeat each year. Models estimate their impact. When behavior changes, the estimates become less precise. This often occurs during economic transitions. Early January is a common challenge. Hiring patterns shift abruptly. Temporary jobs end. As a result, weekly data may appear volatile. This does not reflect real-time economic change. Analysts rely on smoothing techniques, 4-week averages, year-over-year comparisons. These tools help stabilize interpretation. The latest jobless claims report fits this pattern. A short-term movement within a stable range. Understanding the method improves clarity. This has been Veriscope News. Verified news, clear context. Today's report examined weekly unemployment claims, the data, the background, and the broader labor market setting. The key takeaway is stability. The numbers show movement, not momentum. We will continue to track confirmed data. We will continue to explain it clearly. Thank you for watching. We will return with the next verified update.